Using trading tools to become a smarter trader. Most beginners enter the market with excitement. They see green candles, they hear success stories, they imagine fast gains, but the market is not impressed by excitement. The market rewards structure, it rewards discipline, it rewards traders who use tools, not emotion. If you want to become a better trader, you must stop guessing, you must stop chasing, and you must start using tools that help you make decisions based on probability, not hope. Today, we're breaking down the essential trading tools that help beginners protect capital, manage risk, and improve timing. Because trading is not about being right, it's about managing risk when you're wrong. 1. Buy close to support, not in the middle of nowhere. Let's start with one of the most important concepts, support. Support is a price level where buyers have previously stepped in and pushed price back up. It's a floor, a foundation. If a stock has repeatedly bounced at $100, that level becomes support. Now here's the rule for beginners. Buy close to support. Why? Because your risk becomes small and defined. If you buy at $102 and support is $100, you can set your stop loss just below $100. If support fails, you exit. Simple. But if you buy at $115, far from support, and price drops to $100, you're down big before you even react. If price does not come back to support, do not chase it. Wait, either it pulls back or it creates new support higher. Patience protects capital. 2. The 6 to 8% rule for stop losses. The industry standard risk management rule for many traders is simple. Set your stop loss 6 to 8% below your purchase price. Why? Because if price drops 6 to 8% against you, something is wrong. Momentum has shifted. Buyers are not defending the level. And statistically, when price breaks 6 to 8% below entry, it often continues further. The goal is not to avoid losses. Losses are part of trading. The goal is to keep losses small. A 7% loss is manageable. A 30% loss is emotional damage, which brings us to bear markets. 3. Understand bear markets. Bear markets in stocks are typically 30% to 50% drops from highs. That is not small. That is structural decline if you don't use stop losses. A 50% drop requires a 100% gain just to break even. That's why risk management tools matter. Trading is not about surviving one trade. It's about surviving long enough to catch big trends. 4. Key rule. Trade with the trend. One of the biggest beginner mistakes is fighting the trend. If the market is trending upward, higher highs and higher lows, trade long. If the market is trending downward, lower highs and lower lows, be cautious or look for short setups. Never fight momentum. Momentum is like wind. Trading against it drains you. Trading with it carries you. Swing trading works best in trending markets. It struggles in sideways, choppy markets. So here's another rule. Don't trade markets that are not volatile. If price is barely moving, opportunity is limited. Volatility creates opportunity, but it must be structured volatility, not chaos. 5. Fibonacci retracement, taking profits strategically. Now let's talk about something many beginners misuse, the Fibonacci retracement tool. Once a market bottoms and begins trending upward, you can use Fibonacci levels as zones to take partial profits. Why? Because these levels often act as resistance during a recovery. The common Fibonacci retracement levels, like 38.2%, 50%, and 61.8%, are areas where price often pauses or rejects. They are not magical numbers. They are psychological reaction zones. If you bought near the bottom and price approaches a key Fibonacci zone, consider taking small profits. Why? Because price may stall. It may consolidate. It may pull back before continuing higher. Locking in partial gains reduces stress. It gives you flexibility, and flexibility is power in trading. 6. RSI, finding value zones. The Relative Strength Index, or RSI, is one of the simplest and most useful beginner tools. It measures momentum. It shows whether an asset is overbought or oversold. Here's how beginners should use it. If RSI is above 70, the asset is considered overbought. That doesn't mean it must crash, but it means upside may be limited short term. If RSI is below 30, the asset is considered oversold. That means price may be undervalued short term. Here's a powerful tip. Change your chart time frame. Switch from 1 day to 3-month view. Sometimes RSI looks neutral on the daily, but oversold on the bigger time frame. The bigger time frame gives better perspective. RSI doesn't predict the future. It highlights value zones. Use it as confirmation, not as a standalone signal. 7. EMA, dynamic support and resistance. The exponential moving average, or EMA, follows price as it moves. It smooths out noise. It acts as dynamic support in uptrends and dynamic resistance in downtrends. If price consistently bounces off the 20 EMA or 50 EMA in an uptrend, that EMA becomes a reference level. If price breaks below it with strength, that's a warning sign. EMA should not replace your drawn support lines. It should confirm them. The more tools align, support level plus EMA bounce plus RSI oversold, the stronger the setup. Trading is about stacking probabilities. 8. Bollinger Band Bounce Strategy. Bollinger Bands help measure volatility. Standard settings, 20-period moving average, width set to 2 standard deviations. The center line is the moving average. When price touches the lower band, it may be oversold short term. When price touches the upper band, it may be overbought. The bounce strategy means looking for price to bounce off the lower band in an uptrend. But here's the key. Bollinger Bands work best in trending markets. In strong downtrends, price can ride the lower band for a long time. Never assume a touch equals a reversal. Always confirm with RSI support and trend structure. 9. Support and resistance, the foundation of everything. Support and resistance tell you where battles happen. Support is where buyers step in. Resistance is where sellers step in. If price approaches resistance and fails repeatedly, expect rejection. If price breaks resistance with strong volume, that's a breakout. If price breaks support, that's weakness. Support and resistance form the skeleton of your chart. Everything else, RSI, EMA, Bollinger Bands, adds muscle to that skeleton, but structure always comes first. 10. Putting it all together. Let's say you're looking at a stock. Price pulls back to support. RSI is near 30. Price touches the lower Bollinger Band, and it's above the 200 EMA in a strong uptrend. That's confluence. Multiple tools aligning. You enter near support. Set stop loss 6 to 8% below entry. If price rises and approaches a Fibonacci retracement zone during recovery, take partial profits. Let the rest run. This is structured trading, not guessing, not chasing green candles. Final lesson for beginners. Tools do not guarantee profit. They increase probability, they reduce emotion, they create structure. A beginner without tools reacts emotionally. A trader with tools reacts strategically. Buy near support, cut losses at 6 to 8%, trade with the trend, avoid low volatility chop, use Fibonacci zones for profit taking, use RSI to find value, use EMA for dynamic support, use Bollinger Bands to measure volatility, respect support and resistance above all, because trading is not about winning every trade, it's about managing risk so that when you win big, and when you lose small. That is how tools turn beginners into disciplined traders.